Hello, ladies and gentlemen, and welcome to today's podcast with myself, Russell, and
me, Chris. Hi, Merry Christmas.
I know
Happy holidays.
We're getting so close to the expensive day.
Well, yeah, I mean, we're quite lucky. I think this year it's running a little bit later than it would normally.
Yep.
Normally by now I'm kind of done for the year, but we've got a few things on the calendar for this week to keep us entertained.
Still waiting for this Santa rally.
Yeah.
Will I be waiting in vain?
We'll talk about this. There's a few concerns around the market at the moment running into Christmas, which, we'll touch upon today. Or maybe it's worth bringing them up. Yeah, we've seen some pretty nasty action last week. We had the Fed meeting last week, which went through relatively, not completely unscathed, but that wasn't really where the damage was done. Markets were pretty buoyant. It was really the earnings that crushed markets last week. If you share the screen, have a look at Oracle, which was the earnings that came out after the close on Wednesday night. So we had the Fed, markets were actually okay post-Fed, and then Oracle's earnings, not one of the Mag 7, but it's all tied together in the big circle jerk that is the AI feeding of each other's balance sheets. And Oracle's, I think, famously spent 300 million on their venture into AI, and obviously yet to see too much coming back from it. And as a result, the earnings were pretty nasty. So down from what's that price, 223 down to 184. So you're looking at 25-30% declines pretty much on this, which is pretty heavy for a Wednesday post-Fed. So given that the move in the Fed wasn't horrendous, and if you look at the S&P by contrast on Wednesday night, we can see this with a little bit more clarity.
Yeah, did that Oracle spill over onto the S&P and the NAS as well?
Well, you can see, from 7 o'clock we had quite a nice move, 50-point rally on the S&P, and then post-earnings, it was a bit of a post-market, pre-market capitulation all the way back down to what was actually the put wall on the SPX for the day of the Fed. So kind of did this whole horrible range. It's something we see quite a lot actually in on Fed nights, is sweeping highs, sweeping lows.
Yeah.
And post-Fed swept the highs, swept the lows, managed to go again on Thursday until you've guessed it, we had more earnings, this time from one of the Mag 7 characters, not a Mag 7, but one of the heavyweight 8s, do you want to call them that? Post-earnings, I'll get back on the extended trading hours so you can see the real moves here. After the close, we had an initial move up, and then on the call, some pretty bad news out from Broadcom as well. So down from 418. Yeah, we're down pretty meaningfully on this measure as well from those levels. Sitting down, let me not make it up. Yeah, about 20% as well. So this is what's led to the unwind, I would argue. Or certainly most of the unwind has been all related to this tech story.
So maybe the AI story is unraveling.
Yeah, and in a way that you wouldn't necessarily expect it to have been on a rate cut. I guess there was one other thing that was slightly concerning, which was this repo story that they're going to start maybe injecting a little bit of liquidity again into the market. Normally, they do this for a reason, and perhaps the broader market is looking at the Fed and going, okay, why do you need to start injecting this liquidity? What are you seeing in the market that is a concern, and are there concerns that were maybe not and haven't yet been pricing in the market, which has perhaps led to this follow through that's really lasted every day since Thursday through Friday again yesterday. It's been pretty ropey action on the whole for the S&P. Although I say this, we're not too far from the highs, are we really? It's been okay, but pretty. We've got the extended trading hours. Yeah, this is live now, right? So we're not doing as bad as the broader tech stocks, but it's definitely getting in the way of the Santa rally that we've been talking about for a little while.
Oh well, let's be fair. This has been a volatile year from the onset. So to expect anything to go to plan this year is probably not, the mindset that any trader should have.
No. For me, I've still got to wake up with cold sweats about April, having been out with some friends the moment that Trump decided to U-turn on the tariffs, and we had the biggest update in my 20-year trading career. I think
we were out on another staff party as well. So traders, if you're out there, we have another staff party on Friday. So make sure you're all at your desks, because the second biggest second biggest move of the year will probably happen on Friday when we're all out of the office, right?
Yeah, you got to let these things go when they happen. It doesn't pay you to kind of bask in your own pity when these things occur. It's not just against you. It's just the reality of trading. You're not going to be at your desk for 23 hours a day, 5 days a week, or even 7 days a week if you trade crypto. It's just not possible. So you're going to miss things. Unfortunately, missed a pretty big one. But you always look at these things and go, oh, well, I couldn't have missed. I would have made money on that day. You can still get done on volatility in those moves too.
Yeah, you can get done on spikes and stuff like that, yeah.
Chances are it would have been okay.
Famous last words.
Yeah, exactly. So let's see what's happening with this. But this repo thing, we had more injections from the Fed yesterday. 5.2 billion, I think, was injected, which is the 6th largest injection since COVID. So it's an abnormal amount of money for them to be chucking into the repo market. Again, more kind of worries about what they call about the plumbing of markets. This is getting a little bit macro, so it's not something we dig on too deep. But you need to keep liquidity going, and the repo markets is a way that the Fed can kind of prop things up. It's not true QE, arguably. I mean, some debates on Twitter about all this,
that's what I was going to say. How does it relate to quantitative easing?
Yeah, I mean, it's not like Fed bond buying in exactly the same way, but it is adding liquidity to the system, so it is stimulus. And you would have thought adding liquidity to the system is buoyant for liquid assets, right? However, if they're doing it for a reason, the question then becomes, are they doing enough? And right now, the market doesn't look too sure. There are some levels further up. We talked about the 7,000 level being like max pain for the option expiry that's happening this Friday. It's like a stretch to get there. We're trading around 6,800 at the moment on the SPX. So when that opens, we're kind of below critical levels. We're at 6,840 was kind of a level where this whole thing looked a little bit ugly as of yesterday, having closed below there. Yeah, perhaps there is more downside before we get up. So yeah, maybe the Santa rally, maybe it's going to be late this year.
Fair enough. Well, it happened on Friday, won't it? We can almost that's almost a guaranteed trade. Okay. Just buy on Friday, and you should be up for the year.
Yeah, probably.
I mean, this might be a good segue to actually talk about how bonds reacted to the decision as well.
Yeah, I mean, Powell wasn't, over his skis with how much these rate cuts are going to be next year. I mean, if you looked at the dot plots, they were still suggesting the median view is that we only get one more cut by the end of next year.
Yep.
So it's not saying cut. And if you look at the daily here for the 2-year yields, it's quite a good barometer of Fed policy. It has eased off since that night on Wednesday. So it is down. It is still significantly down. There is a fear with this sometimes that when the yields are easing off, it can be like a recession indicator because the market starts pricing in that the Fed are going to have to cut rates further than they were anticipating. But we kind of zoomed out on this ourselves earlier, right? And we see this sort of like this almost like head and shoulders style pattern that's been going on since 2022. Kind of hit these equal lows, almost got like a second right shoulder here. In a way, this is a little bit of a falling wedge too, there, right? But this kind of neckline behaviors, potentially at least, if this goes. That could create some follow through, certainly for those technical traders. But zooming in just on Wednesday onwards, the yields are down in spite of the fact that we're only looking down the barrel of one more rate cut on the median view for 2026.
Yeah, I think you've brought up a great point here in how retail traders should at least have an idea of how bonds work, and sort of like at least, fair enough, don't actually trade them if you don't want to. But at least understand where the money is, because bonds literally are where the money is, where all the big money is. It's government debt that they're issuing that big institutes can buy, and like you said, if you're following the bonds, it really does show you a great indication of what these big institutions think that the macroeconomics is going to be in the cycles and stuff like that. So
yeah, a couple of things on that. Like they say that bond market sneezes, the rest of the market catches a cold, or the smart money's in the bonds and dumb money's in stocks. Maybe that's why I'm trading indices, Russell. But yeah, it's important to understand like how this works. It works in different ways at different times. If you're staring down the barrel of a recession, then you'd expect the yields to kind of ease off, and that's not necessarily great news for the stock market. But when we were in peak inflation, it was a really simple trade. It was almost like yields up, stocks down, yields down, stocks up. You could trade the inverse correlation with it. So these correlations do move in slightly different ways at different times. But when you're staring down the barrel of a recession or a little bit of economic uncertainty, which appreciate we're not far from all-time highs here. We're not exactly in the midst of the great financial crisis or COVID here. But people are concerned about this AI bubble, maybe it deflating a little bit before we pump it back up in 2026. So when they're looking at that, maybe the correlations aren't as clear as they were back in 2022 when it was always yields up, stocks down, and vice versa.
Yeah, I mean, there's also a good way to look at bonds, as in the time frame of them, like as in, so you've got 1 year, 3 months, 20 year, 30 year. So sometimes looking at the yield curves of those as well in correlation can be quite helpful to actually assess the macro environment as well, right?
And they say 2 years, like short term, 2 years and below, kind of your STIRs, your short term interest rates. These are more typically managed by the central bankers, because they set policy, right? Yeah. But the market, as the duration of these bonds kicks out, you've got 5 years, 7 years, but really 10 years, 30 years, the big ones in the US, 20 year as well, but 30 years really closely linked to the mortgage market in the US. 10 years are where tons of volume lies as well. They are dominated by the market, because that's the market predicting what the Fed will do basically on average during the next 10 years, whereas the Fed's really only giving forward guidance out on its dot plots, a couple of years.
Yeah, so sometimes the short yield bonds can actually give you more interest rate than the long yield bonds, right?
So this is the inverse yield, the yield inversion that you can sometimes get. So the 2 year minus 10 year is a typical one to look at. I mean, there are people looking at these all over the curve really, but if you look at these, managed to get that on there, I think. If we look at where we reside here, we're back with the 2 year minus the 10 year being negative, but we saw a situation, normally I do this the other way, 10 year minus 2, so this has made it slightly more tricky for my brain, but we were back down into normal territory. This period here during 2022 when rates were up, this is when the short-term rates were higher than the long-term rates, but that has now uninverted, and we're back into normal normal market conditions a little bit here, which tends to be better. Normally the 2 year going above the 10 year was a 95% hit rate on a recession incoming.
Yeah,
I mean, there was a technical recession in 2022, but it wasn't that being 2 consecutive quarters of negative GDP growth, but we didn't get bad jobs data during that period, so maybe we're not staring down the barrel of that at the moment anyway. We didn't really truly get a recession, certainly by the media's view, back in 2022 anyway.
Okay.
One thing I'd say on bonds as well, though, is if you said retail traders maybe don't trade bonds, there's a good reason for this. If you're trading bonds, you really should probably be trading futures, because the spreads on most of these retail platforms is really prohibitive. Like, you're paying much more abnormal spreads than you would do if you were trading like the S&P, for example, on a retail platform where the spreads are pretty narrow and very similar to that you would trade on the futures.
Okay.
The other benefit of trading futures is you can be in the book, you can be the liquidity. At that point, you don't pay any spread. So that makes a huge difference if you are trading bonds. If you're trading 3 points versus 0 points on your spread, that is a game changer.
Of course, yeah. Okay, well, it's one of those markets that are, just for the big institutes then, right? Unless you are happy to pay the spreads.
Yeah, I mean, well, just don't, or set yourself up with a futures platform. But I appreciate that's a leap for a lot of traders who are much more familiar with CFDs. But if you do find yourself interested in that side of the market, it will pay to learn to trade these things through the futures market instead.
I mean, a lot of countries have, you can only trade futures anyway, right? Because the CFDs are actually banned in quite a few countries, aren't they?
Yeah, US hasn't had a big pickup with this. That's why the options market's so big in America, because you can either trade futures or options in most states. I know India's only just started doing CFDs in the past couple of years. That was always super option heavy. But I mean, the futures market is, I trade futures. I love the data that it gives you. But I appreciate it's maybe a little step for some people, but I think it's a step worth taking.
Yeah, I mean, it's just, ultimately it's just about learning how to recalculate contract sizes, and sort of like factoring that into your trades as well, because, you're a bit prohibited on the amounts that you can actually trade unless you step down to sort of like smaller sized contracts.
They're pretty forgiving. Like the micro contracts are
Yeah.
pretty small. I mean, you're probably not going to get away with trading like a 500 quid account.
No.
But if you've got $5,000 or so, you could probably open a futures account and do some micros. Be careful with the NASDAQ, by the way. If you ever do this, the NASDAQ contract is ginormous. If you hit one of those, when you're expecting it to be the same sort of size as the S&P, you can catch a cold pretty quick.
So is that not £12.50 a point as well?
Well, is it $12.50 a point? I mean, it's on 0.25 ticks,
So
right? So I think
sorry,
it's per tick. So
there's more,
points,
points,
which means then you know it's basically the same size as an S&P, and you're looking at an S&P near 7,000. You look at a NASDAQ at vastly higher prices for the same volatility. If you're using you're not going to use a 5-point stop on the NASDAQ. More than likely, you're not going to. Whereas that's quite reasonable on the S&P. It would be reasonable to maybe use a 20 or a 30-point stop, and therefore your risk is 6 times as great. So just be mindful of that. Start with micros and work your way up. They're typically a tenth of the size. You get micros in gold. A lot of people trade that at the moment. So I don't think it's a big stretch. If you trade S&Ps and gold a lot, which I do, it's really not that hard to move from CFDs into futures if that's something you wanted to try.
I mean, the positive side is that you, I know a lot of people don't use this, but you can get to use order flow and stuff like that, so you can really see, you can have like an X-ray view of candles and stuff like that, so you can see where the orders are actually going through on candles instead of just looking at a candle and saying that's a sell candle or that's a buy candle, right?
Yeah, I mean, the data is something I believe all day traders should be using, even if they're trading CFDs.
Of course.
So you're very welcome to trade CFDs like the SPX contracts or the US 500s, whatever you want to call them, on your broker. But using that data is really inexpensive now. Like TradingView do the whole thing for, the data's like £8.40 a month for the CME stuff, which is incredibly cheap compared to what it used to be. Plus the functionality, maybe it's 50 quid a month, but you can get it on the discounts, which are a lot cheaper for the year at certain times. With that information, you can still trade it, because if it's going to move against you 5 points on the futures, it's probably going to move about 5 points on the SPX as well. Yeah. So I would keep that in mind. Even if you're scared of using futures to execute, I would still maybe use 2026 as a way to start taking on that data, because I think over the next few years, we've had a lot of years of pattern trading when I was new to it, and more recently like ICT concepts and smart money or whatever you want to call it. I think all of this stuff in 5 years' time will be order flow. So get ahead.
Yeah, I think that's a fair assumption. Because I feel like people are getting more educated in the trading space, and people are wanting, more clarification of how to kind of take trades. And, I think as this information is becoming more readily available, even on sort of free platforms, that, there's a lot of places now you could actually just go to and they would teach you order flow for free. On certain channels, which I can't mention because we're on a TikTok stream, but thank you very much, TikTok. So I think it will be adopted. It's just people just have to catch up with the institutes, right?
Well, the information's available. It's really inexpensive. It used to be a lot more expensive 5-10 years ago, but the information is there for you. I don't understand why you wouldn't take that on board to just add it into your criteria, or even if it's just purely on the execution moment. You don't need to be taking on board every single level that it spits out to you, but in the moments when you're executing, if you're using order flow to see when institutions are showing up, to see where there's divergences between the action and the price, I think this is a really good way of just increasing that win rate, which is all we're really here to do.
Yeah, I mean, but kind of with order flow though, it's more of a, as I understand it to be, it's more of a short-term kind of trading. So if you're doing swing trading and stuff like that, maybe order flow isn't quite as useful. I would say maybe volume profiles are probably a little bit more useful.
Although you can still use them. I mean, I still mark up daily levels on the order flow every day. I've got people who now use it on the 30-minute close. So you don't have to be, flying by the seat of your pants watching, the 1 minute and 5 minute time frames, which I kind of do in those hours that I trade in the afternoon. You don't have to do that. You can use the bigger picture stuff if that suits your strategy and your style, and if it kind of complements what you're doing and just gives you that extra edge. I still think it can work even on daily and
Well,
half-hourly time frames.
I suppose it could show you absorption of levels, so you know if it comes back to that level that there might be, more absorption and a movement the other way.
Yeah, and where all the imbalances are, you'll see them. That's what I'm marking up every day on the large time frames. Even though I'm very much trading on the short term, I just want to see how markets are reacting in those areas. So just marking up areas of interest. It doesn't have to be that way. It's just one of the ways I do it. But yeah, I think it's really reacting to real action in the market rather than a hypothesis around. I know we have people in here like Enzo, who's very mechanical with his trading moving averages, which we can talk about in a second as well, about these CTAs, which is interesting. But that's kind of a statistical edge that he has in the market, and he just knows if I just repeat this every day over a year, I'm going to make money. Yeah. Whereas I prefer, and I know a lot of the guys in here prefer, looking at truly what's happening, and then you can maybe get a slightly better view of what's truly happening live, and rather than looking at a 50 and a 200 moving average and working out information based on days and days worth of data. I can see in the 1 minute candle exactly what's happening. Hey, it's not always going to give me a 100% win rate. Nothing will, but I feel like it gives me a confidence that I would struggle to trade without these days. Okay. There's actually a comment here on TikTok. I know we don't normally do comments, but it popped up and it looked quite interesting. Someone's saying he expects today's news will affect gold's rise again. So the Fed's interest rate cut sometimes gives. Yeah, let's talk about the news. This is what we're here for, right? We've been waiting a long time for this. It's already been take it back to the fundamentals is what we concentrate on, try and concentrate, and we've gone on this massive order flow rant. Yeah, there we go. 1:30 non-farm Tuesday. Don't say that very often, do we? We got non-farm payrolls out. We've got the lowest forecast in 5 years, well, basically since COVID. Not great expectations around this unemployment rate. Expected to be up 4.5%. Also not a beautiful figure. This is all coupled together with some retail sales numbers as well, which we don't normally get at this time. So it's going to be an absolute barrage of information. But undoubtedly, that non-farm payrolls figure is going to be one we pay close attention to. The numbers have been bleeding out a little bit until we had that very late data a few weeks ago, which kind of got things back on track a little bit after quite a flaccid end to the year, you would say. But yeah, things are looking a little bit more buoyant given that beating of the expectations last time. But it's a big number. I think the market is going to care more about this one because it's slightly more live. But I think we're all in the financial world looking forward to getting this data back on time. So when we get back, is it the 8th of Jan? So it's a little bit later maybe than we'd sometimes get it. But we are due to get the non-farm payroll figures back at the beginning, first Friday of the month, typically, going forward, which would be great because it's been a strange time for news trading because it's just not been that new, that relevant when we get it. Yeah, fair enough. There was some news today from the UK as well, bringing it closer to home. Yeah, good news. It's actually good news for a change, right? Yeah, it was like bad news the other day, and today's good news. I mean, there is some arguably bad news. Average earnings is wages as well. This often feeds through to inflation. They say that wages are sticky inflation because, as we know, oil prices, they can go up with a war, and when a war is coming to an end, as it is now, oil prices can come down with all this potential new Russian oil that's coming online. Haven't they just? A little bit. Finally getting towards those levels we were chatting about all those months ago. Back in April and May, those two lows are still being eyed. I'm curious to see how they react at that point. But with wages, when they go up, if you speak to your boss and you say, hey, here's a pay rise, or your boss says, here's a pay rise, you go, thank you very much. The next month they come back and go, hey, do you want a pay cut? You say, no, thank you, in no uncertain terms, right? So wages go up and stay up. They don't come down in the way that commodity prices can. So this is a little bit of a concern, seeing this upward revision from 4.8 to 4.9 and a big beat on the expectations, 4.7 to 4.4. Which means people might be willing to spend more. So that would filter into the economy, and so run it hot though, right? It's one of those where do we get back to a place where economic data is okay, but it's met with really high inflation and they have to raise rates, which means probably the economic data won't be that great 6 months from now. It's always good news. We're in a rock and a hard place. We're going to be here for another 5 years, in my opinion. I don't think we're getting out of recessionary pressure without some inflation pressure coming out, and vice versa. We're probably not curing the inflation problem without getting mighty close to popping this place in a recession. I think that's the government's problem now. Is
everything that they do, you know, any data that comes out, it's so volatile to all the other data now, is that we're just going to be bouncing around in these kind of like grey areas. For
makes good music to my ears for a day trader.
good trading, yeah, I suppose. Yeah. Not so good if you're out there on the street trying to, well, not on the street, but if you're out there trying to afford stuff in the shops with the ever rising prices.
Well, that's it. Let's see how we get on. So just to kind of answer the question, you know, obviously we need some weak data out of this today in order to get gold pumping. We obviously have the looming, excuse me, potential deal in between Russia and the Ukraine. Seems closer than ever, apparently, according to Trump. Doesn't feel that close necessarily to me, but that could take a little bit of froth out of the market. I mean, I'm still super bullish on gold. Yeah, there's this kind of like de-dollarization story happening. So, and we're getting to the time of year, January, February, where seasonally gold is its strongest historically. So, yeah, I'm bullish gold in general. The news will make this very, very clear to me today as to which way I want to trade it.
Okay, cool. I mean, we talked a bit about oil there. It might be good to show a chart and a bit of a breakdown of what's going on. And excuse me if I don't share your thrill of Trump's opinion on anything, because you know, can anything he say be trusted?
I'll leave that one there. We are in an ICT trader's dream, right? Some stop runs, liquidity, as they call it, levels at which this market would likely flush out some longs. If we were to take them, we are mighty close now, right? Less than $1 away from taking these three equal levels. In fact, we've taken one of them already, but these two are very, very close. Action around here will be interesting. If we are looking down the barrel of a recession at the same time that Russian oil supply is coming back up, hey, I don't think this springs back and does a nice, you know, taking out of double liquidity at the other side necessarily, but this is cheap, right? This stuff, I think long term, I've got no problem kind of picking this up, not financial advice, but as a day trader, this will certainly be an area of interest. We could even get this today, you know, so watch those two levels from back in April.
It will be Friday, remember?
Oh, of course.
Yeah, it'll be Friday.
Yeah. Of course.
So, yeah, something for you guys to look forward to on Friday. Nice, great big oil trade.
Probably. I'm happy with the year. I don't need another one on Friday. I'm happy for this to roll off. As you can probably tell by my voice, my body is slowly shutting down before the end of the year.
Well, you was hoping you was going to get ill sooner rather than later, so
get it done.
You might be getting
Christmas.
iller on this stream, but
yeah.
By the end of this stream, you might be fully ill.
Indeed. Two levels I want to talk about quickly before we sign off on these. For me, obviously, the stock markets are really, really interesting. The SPX, I often use the black bull one, which is closely priced to the one you have to pay for, the CBOE. Here we go. So this 7,000 level is max pain. So we spoke about this last week. Friday is option expiry. In fact, there's also the 7,000 level is the JP Morgan price for the 31st exposure. So that's all the way up at 7,000. So this is an area where I've been thinking we'll get the market to before the end of the year, which keeps me bullish in spite of all of this. However, the NASDAQ, I don't know what the short, I'll just do the regular NQs here, but this is at 24,500 is the max pain for the NASDAQ. So that could take you down into kind of towards the levels that we had in late November. Maybe it wants to go and do this first. I mean, we've been selling off pretty hard at last, well, not hard, but, you know, inching lower and to say below critical levels at that 68.40 on the S&P. If we maintain below that, then the NASDAQ may want to go have a look at this 24,500 level, get down there. Maybe that's your trade to try and run this back up until the end of the year. But if we're going to get there, I'd like to see it happen today or tomorrow. They call it like turnaround Tuesday, right? So if we can just get a big flush today down to around these levels, I feel like it might be a case of like pushing a beach ball down underwater and maybe it pops back.
Well, I mean, it's got the reason to do it today with the data coming in. So,
and if we get there, I can be long and just hold through that big rally we'll get on Friday as well.
Yep. Maybe I'll bring my laptop to the staff party on Friday.
Maybe. Yeah, watch those two levels. NDX 24,500, and then to the downside, if we want to start moving higher, 7,000 looks likely. If not by option expiry, certainly by the expiry of the JP Morgan contract on New Year's Eve.
Yep.
But yeah, my trading will be done before the end of the week. So if it's not happening, I might have my levels in, but I'll probably just be letting things ride by then.
Fair enough. I mean, sometimes it's better to be safe than sorry, right?
Right. And there's a whole year ahead of us starting Jan. It's always a good time to get back into this.
And probably another volatile year, I should imagine.
Yeah, I don't think it will be as volatile as this year. I think Trump has, he's hit the market hard. He's coming guns blazing, and he does like a bit of a cleanup operation, right? It's kind of his political mantra. I think he did create the mess, and now I feel like it would be unlikely for him to go and make more mess. It's a midterm election year as well. So, the guy's a populist. He doesn't want to be losing votes. So I think it could be a much steadier year, 2026.
Okay,
I would say April was probably a little bit too unsteady, even for my volatile love for trading.
We're still kind of waiting for, a meeting between him and China to sort out the tariffs once and for all. So, I mean, he wanted to get that done by the end of this year, but yet that is unsolved.
Yeah.
He wanted to resolve this conflict by the end of the year, but that is still unresolved. So maybe early next year we will get some interesting moves, right?
Indeed. Well, I see one last thing's come through on here. Question being, can you speak on the mentality of waiting for your trade instead and not being convinced by the market? I think you're trying to say here. This is trading in a nutshell. It's about patience, right? You have to have an idea, you have to have a concept, and you have to be patient enough to wait for it to happen. They say in trading it's very easy to make money, but it's even easier to lose money foolishly. And if you're not waiting for your setups to come, whatever those setups may be, you are probably giving money away foolishly. So if you can just turn this off, you just turn that switch off, you're going to set yourself for much more success. You don't have to be trading every single day. You don't need to be putting trades on in every single session. You've got to just wait for your setups to come, and if they don't come, don't trade. It's black and white, in my opinion. People struggle with just the dopamine requirements of their mind and kind of use trading as a vehicle to get those hits. In the end, trading shouldn't be that exciting. I quite enjoy doing it still, but it's not something where I'm flying by the seat of my pants when I'm doing it. It's structured. I've got an idea. I've got to be patient for my levels. And when I get to my levels, I want to see order flow confirmation in order to take them. If I don't, I won't trade. Everyone just needs to find a way of getting almost like a little checklist. If this, and this criteria are met, I trade. If not, I'm a great risk manager. And I walk away from that day having maybe not traded, but knowing that I'm probably going to make money more than people who just traded for no reason.
Yeah, I actually mentioning this, I fell victim to this yesterday. On the ES, my bias was that it was going to sell off at least to the POC of a amalgamated level that I had, and I knew that later on I had stuff to do, so I couldn't be on the charts. So I thought, let me try and get in early. So I just put very, very small risk, but just made my stop loss a bit bigger, and thought, that would be fine because, it's in a range, and I just, it probably be all right. But it managed to tip me out by about 5 tiny little points, and then it flew down all day.
Yeah,
and I was just
yeah, that's the difficulty if you are, there are only specific times of the day that you can trade. Just plan to optimize a system for those times, right? It's difficult if you have different days where maybe sometimes you can trade in the morning, sometimes you trade in the afternoon. If that's the case, you probably want to have like a different strategy for those markets because they behave differently at different times. So just something that will work on a 5 a.m. on a Monday morning might not be the same strategy that would work at 2:45 after the US stock markets have opened. So try and find something that's if you can do something at the same time every day, that is easier. If not, try and find something that works at the specific times that you're trading. And if you're not able to show up for them, come back the next day.
Yeah, I think that's a good point because the markets aren't going anywhere, but your account could be.
Yeah. Well, Well, I just like the final comment here. It's good to see that you guys still fight this battle. I mean, trading is a war, right? Every day is a battle against yourself, against the market, against other traders, but mainly against yourself and predispositions to fall into bad habits that maybe you've created and you've tried to find a way to stay away from. So just always go into a trading day with the mindset of, I'm just going to trade by system, and if I don't, I'm actually a good risk manager. It's the easiest way to do it, rather than thinking, a lot of people thinking, I'm a trader, I have to put trades on. No, you're a trader, you have to put good trades on.
Yeah, so a lot of the reading books and listening to podcasts and stuff, a lot of the best traders in the world, they motivate themselves to not make these stupid decisions by reinforcing bad trades at the beginning of the day. Some of them even put them up on the wall, like their worst days and stuff like that.
Yeah.
You know, and you know, one of them was saying that you know, that bad day is because he took a trade without you know, just on an idea. Yeah, he didn't use any of the data to back it up. You know, he yeah, which is really what you should be doing, is you should be using data to back up your idea. And if you, well, I mean, let's be honest, that's exactly what I did yesterday as well. I had an idea, the idea was right, the timing was wrong, because I didn't have a chance at that time to be able to go and look at order flow data, hence why, yeah, I got stopped out. So
yeah, it's a battle.
Yeah, so maybe if you can't put everything in, don't put anything in.
Yeah, and it's just like habit creation. If you the more frequently you trade trades that were never in your system. Ooh. You can get your mum on the stream.
No. Wow.
Yeah, the more you create these habits where you're doing what's the word, like incorrect behavior, the more likely you are to continue, or under pressure at a later date, to fall back into that behavior. So if you just create habits, positive habits every single day, and just keep turning up and hitting them out of the park every single day for even 2-3 weeks, that's how long they say it takes to create new habits, good and bad. You'll be surprised how easy it is to stick to this discipline story that you hear a lot of traders talk about. It's not really discipline, it's just great habit creation. Stick to it, do it, make that your objective, maybe from the 1st of Jan to the end of Jan. I will never take a trade that I haven't planned, that is not meeting my criteria. If you succeed in doing that, you've got a great chance of getting the whole way from Jan through to December, sticking to that path. Okay,
cool. Well, that's some good advice for the people out there going into the new year. Maybe a New Year's trading resolution regarding psychology.
Exactly.
But you know, look, guys, we're always here for you. There's a free Telegram group you can join. We sometimes have Enzo coming on to give talks about psychology as well, which are all free as well. So could be good for you to join those. So
great.
Okay, cool. Is there anything else that you would like to add today? Anything that we might have forgotten?
I think this voice has probably run its course for today.
Okay.
I've got a class to teach shortly, so I should probably save a little bit for that.
And you wasn't up for singing Christmas carols next Monday because nothing's going to be going on in the market?
Yeah, I think this is maybe our last podcast for the year. Yeah, I don't intend to be doing a great deal after Friday.
Okay, well, I suppose it's a big goodbye from us then for the end of the year, and have a great celebration, and don't do anything silly with your trading accounts running up to the new year, because it could be volatile, and keep your eyes peeled on Friday, because we can almost guarantee you there's going to be some big moves, whilst all of our office miss it.
Quite possibly.
Okay, well, thank you very much,
year.
and goodbye.